So the next module, the next chapter that we're going to study covers the accounting methods for pensions. Now, a lot of this module is actually going to cover a sort of antiquated pension scheme, which we call defined benefit pension plans. A lot of companies today have switched, made the move over to a defined contribution plan. But it's important that you know both, because you could be accounting for a company that still uses a defined benefit plan, and also you could be tested on a defined benefit plan on the CPA exam. And so it's imperative that you know how to do both ones. Accounting for pensions is pretty complex. If you're following along in the book, which I encourage you to do, it will be hard for this chapter. I encourage you to follow along in the book in general, but in this chapter, there's a bit of a disconnect in terms of how I like to solve pension problems and how the book solves pension problems. I have a much simplified measure of solving pensions, and I believe that it presents it in a much more interesting way. Surprise, it deals with T accounts rather than worrying about a bunch of journal entries. But really what the pension chapter is about is focusing on the relationship between footnote disclosures and what actually gets reported in the financial statements of the firm. And so, of course, a pension plan is just a retirement fund put away by a firm in order to compensate its employees for their post-retirement. We are accounting for the present day expense of the future payments that employees will receive. And of course, because we account for items under an accrual basis, we don't wait until our employees retire to recognize the expense of these plans. We want to match it to the revenues it helps generate. So part of what we do to compensate our employees and part of what our employees are earning with their service to the firm is the entitlement to these programs. And so we should match an expense every period, even though they will not be using it until they retire. So there are two types of pension plans, as I mentioned. A defined contribution plan is the new style of plan, easy to account for. Pension expense is just going to be the cash contributed by the company to the employee. So in this case, cash actually equals expense at a point in time, or I should say during a period of time. You know, if the company contributes $100,000 to their employees' pension, then $100,000 is the expense. It is that easy. Once the money is contributed by the employer, then it is all up to the employee to wisely invest the money and obtain their retirement benefits. The old style of benefit plan is the defined benefit plan. And this is where there's a lot of complex accounting. Pension expense is not just cash contributed. It is a lot of items that we will talk about. And the firm is the one who bears the ultimate responsibility of ensuring the welfare of their employees in retirement, because they're defining the benefits that are going to be received upon retirement rather than defining just the contribution to the employee. So let's look a little bit more at defined contribution. It'll be a short look, I promise. Like I said, it's the employee's responsibility for the benefit. The employer's responsibility for the benefit ends when they put money into the fund, right? The contributions are defined. I'm going to give my employees match up to 10% of their monthly salary, whatever the matching is to most of these plans. 401k plans, 403b plans are the most general common type under this sort of plan. And it's also going to be likely the type of plan that you will have when you graduate and get your first job, or not your first job, but when you get your professional career as an accountant here. So you're going to invest an amount of money each month and your employee will kick in a return percentage. How it's invested is entirely up to you. That means that you have to make the selection of investments. And, just as a side note, so for some real world advice, always make sure that you invest an amount of money in your plan, at least up to the point where your employer will match. So if they would match up to 10% of your monthly salary, invest 10% of your monthly salary into that plan, because otherwise you're just giving up free money. And the employee's responsibility is greater under this type of plan, because then you actually have to make a wise decision about what mutual fund, what international portfolios you want, how much you want in bonds, how much you want in stocks. And again, it's important that you remember that the money is in a retirement fund. All that's the only part that the employer has to worry about. It's now the employee's problem. So if you put all your money into an Australian equity fund and then the whole country sinks into the ocean, if you go back to your employer and say, hey, can you help me? And what would the employer say? They'd say, oh, no problem. We got this pile of money. Or, hey, let's try to rebuild this together and see what we can come up with. No, they're going to say, tough luck, employee. It's your fault that you put all your money into the land down under and it went under, right? So that's a defined contribution plan. Employees are the responsible party. The employer doesn't have much responsibility at all, except putting money into the fund for the employee. Because of that, it's a very simple journal entry. Like I said, pension expense equals the amount of cash that the employer contributes to the fund. That's all they have to record. It's that easy. End of story. That's a defined contribution plan. Don't you wish it ended there? Defined benefit plans, believe me, you will wish in just a moment. Defined benefit plans are the more complex, old style of plans. It's the employer's responsibility for the benefit, because now they're saying, I want my employees to get $5,000 a month every month after they retire. That is the definition of our benefit, right? So now you're not just saying, oh, the definition of our benefit is we'll match up to 10% of your salary this month. That's very easy to calculate. But you're saying, I want to set aside enough money today so that in X number of years from now, and who knows what X is, because who knows when exactly every employee is going to retire, I want to have enough money so that X number of years from now, they can draw $5,000 a month until they die. So there's a lot more variables going on there. So the firm's responsible for those benefits. They have to know a lot of things about the employees and the expected payments they're going to make to them, not to mention the time value of money and a whole lot of other things, right? So the employee's responsibility is just to collect the check. They don't have much responsibility at all under a defined benefit plan. You just get your pension check and you cash it. Great. How do we determine then, as the employer, how much money we need? Well, we have to have a lot of things like or an idea about a lot of things. How long are they going to work for us? How much they're going to be making? How long they're going to live after they retire? How much, if any, of the benefits go to survivors, et cetera, et cetera, et cetera. So as you imagine, that's a complicated process. Thank God we don't do much of that. Actuaries are the accountants that would be involved in determining the models for these figures. They are going to be instrumental in defining the benefit formula that would give us exactly the amount that we need to put aside today to ensure that our employees have X amount of benefits when they retire. So what you are responsible for doing as an accountant is taking what the actuaries give you and determining how that affects the accounting system. You don't have to come up with all these estimates because you're not that mathematically inclined, believe it or not. Like I said, people often come up to me and say, I could never be an accountant because I'm not that good at math. And I'm like, oh, believe me, there are people much better at math than us in this world. We just are more information engineers. We take the results of other people's math and put it into a system so that we can handle the data, right? Anyway, so let's think about what goes into a defined benefit plan, or how we account for a defined benefit plan. One of the key issues here is an issue of vesting. And that refers to the amount of the benefits that the employee has earned. So it's very important that we understand the role of vesting. My retirement was very interesting, or is very different as a professor. A lot of the times professors vest after 1 year, and that is unusual. So since I officially started on September 2010, if I took another job and left the university on July 2011, how much of my pension fund could I take with me? Well, because I didn't work a whole year, I didn't vest that 100%. So I would be able to take all of my contributions, but anything that was matched by UC Denver, I could not take with me because it had not vested. If I waited till December 2011, that is more than a year after my start date, then I could take everything because I vested 100%. Again, that is rare that I would be able to take everything with me. That's a cliff vesting schedule where I got everything after 1 year. So under most firms, vesting won't happen that quickly. They might, for example, give you a 10%, I'm drawing a blank here, a right to 10% of your benefits per year over 10 years. So if you left after 5 years, then you could only take 50% of what the employer paid in. And of course, like I said, your contributions are always at 100%. So you can take everything you put in there, but only 50% of what your employer matched to that amount. So that's a vesting idea. What goes on with liabilities? Now, there are 3 measures of what we call the pension obligation. That is the amount set aside to appropriately define benefits. So this is what we have to have in order so that our employees will have that certain amount of pay in the future. That again is given to us by the actuaries. There are 3 different types that are reported in the footnotes. These are all footnote disclosures. They do not appear on the balance sheet, even though they represent liabilities of a sort. There's the vested benefit obligation, the accumulated benefit obligation, and then the projected benefit obligation. So what is the difference of each type? The vested benefit obligation just equals the present value of future vested, right, benefits, hence the name, where the actuary's benefit formula only incorporates the current salary and service information. So only current information. The accumulated benefit is the same as the VBO, but it assumes 100% vesting. So this one only looked at what has vested. This one assumes everything has vested. And then finally, the projected benefit obligation is the same as the ABO, but it has also future salaries. So current salaries only vested benefits. Current salary, everything's vested, and expected future salaries. So we're getting a progressively more conservative view of what the obligation is, right? Such that most of the time, well, certainly all of the time, the VBO will be less than the ABO. And assuming that salaries rise over time, which God, I hope they do, otherwise you're in the wrong profession, then that should also be less than the PBO. So the PBO is what we are going to do our accounting around. So this is the obligation we use for accounting. But these other measures are reported in the disclosure notes, right? Now, the assets. Recall that the payments to our retirees are not actually coming from the employer. They're coming from a pension fund. The pension fund is going to be a separate entity selected by the company to manage contributions that are made to the defined benefit plan. So the defined benefit plan is our pension fund. It is not an asset of the company. That is another entity to which the employer moves cash to and then that company then distributes it to the employees when they retire. They don't appear on the company's balance sheet. They do appear in the footnotes, so the pension fund is disclosed. However, it does also, and it also does influence pension expense. So that's the stuff that's in the footnotes. The obligations and the pension fund are referenced in the footnotes. Now, what is pension expense, right? Pension expense is what we're going to do a lot of talking about. Pension expense for the period is a combination of changes we make to the plan assets and the benefit obligation accounts. And so even though they aren't accounts, what we're going to start doing, or what I'm going to do in problems, is have a T account for the PBO and a T account for the plan assets, because as these accounts move up and down, they will influence what we do record as pension expense. They will influence what we do record as an item on the balance sheet. The PBO has a credit balance, as you might imagine, and the plan assets have a debit balance, as you might imagine. And again, we're kind of talking fast and loose because these are T accounts, but they are not actual accounts that go into the ledger that are reported on the balance sheet in this form. So, what goes on the books? We do have pension expense on the income statement, clearly. This is an operating expense. We have a pension asset liability account. What that is, it could be either one, right? So it's a pension A/L account, this is how I short it. But it's either going to be a pension asset on the balance sheet or a pension liability on the balance sheet. And it'll be a liability when the PBO is greater than plan assets. It'll be an asset when plan assets are greater than the PBO. You know, thinking about it in a different way, if I have more obligation than I have money in my asset fund account, then I have an underfunded pension plan. If I have an underfunded pension plan, that means I owe my employees more money than I have currently in the fund, therefore I have an obligation. Or if the fund is greater than the obligation, I then have more money, so I have excess money, I have more economic resources than I have an obligation, so I have a pension asset. So the difference between those two defines my pension asset or liability account. And of course, if it has a debit balance, it is an asset, it is overfunded. If it has a credit balance, that means that it is underfunded. There are also going to be items that end up in accumulated other comprehensive income that we have to keep track of. And accordingly, these items will also appear as other comprehensive income items on the income statement. We'll talk more about these in the next video lecture. Here's pension expense per the defined benefit plan. Remember, pension expense by a defined contribution plan is just a cash contribution. Now we have a lot of other things that go into the baking recipe, if you will, for pension expense under a defined benefit plan. We have service cost, interest cost, expected return on assets. We would have perhaps an amortization of a prior service cost, which could be added or subtracted depending on where the prior service cost is. We have quarter amortization, which could be added or subtracted. More on that in the next, but more on both of those in the next video lecture. And then there's some other things that don't occur very often that we will not really talk about. One of them is called transition amortization, which I would imagine, and I haven't looked recently, but I think most companies are done with that. It was allowing companies to transition to a new, to transition a benefit plan from a defined benefit to a defined contribution plan. And they would have to amortize off their obligation over time. Anyway, but that, again, is something that I think is mostly gone now. But again, if we have time, we might talk about a few of those things. If not, we'll just continue ahead. Pension expense components. So what are these items? Service costs just reflect the increase in the PBO due to services rendered during the year. So this will increase my PBO, which is important to know. You have to know how each of these items fits into those disclosure T accounts. Remember, they're not actual company T accounts, but they are put in the footnotes. They do affect the balance of those accounts. So if employees have worked for me another year, they've earned another year's worth of benefits. That means that my obligation has to increase this by that amount. And again, this is going to be something calculated and provided by the actuary. You don't have to sweat it, but you do have to know what to do with it. Interest cost is going to increase the PBO as well. So we have another increase in the PBO effect from this cost. Imagine that. Costs increase in obligation. Who'd have thought? This interest cost is something that is due to the passage of time. It's a time value of money effect. Think of it like the effective interest method. We have a carrying value, and we know that a year has passed, so there's a certain amount of growth in my present value toward the future value. Now, this is a little different because we don't owe anyone this, there's not a real interest payment due. It's just interest that arises because the present value is growing to meet the future value. And along the way, that means that my obligation has to grow as it gets toward its future value. How to calculate it? We take the beginning PBO balance, just like the beginning carrying value, and multiply it by the plan's discount rate, just like we apply a discount rate to a carrying value of a financial instrument. Again, same idea, slightly tweaked. Then we have an expected return on assets. That reduces pension expense. The expected return on assets does not actually play a role in increasing or decreasing our plan assets. Now, what does play a role is the actual return. The actual return increases my plan assets account. So the idea of the return on assets is, the company contributes money to that pension fund. The pension fund then makes an investment. Off of their investments, then, they earn a return. They invest in bonds, stocks, mutual funds that combine them, etc. Any return that's made by that fund is the actual return. Now, the problem is, the actual return can be pretty volatile, as you might imagine. We'll have boom years, bust years. It'll go up, it'll go down. Now, because of that, we don't want to use the actual return when determining pension expense. We would rather have a smoother, more predictable expected return. Now, what's the relationship between the two? The actual return is what your expected return is, plus or minus an unexpected gain or loss. So there's an expected portion, an unexpected portion. The two add up to give me my actual return. We're going to talk about what to do with that unexpected part. Specifically, it is an OCI, gain or loss, that's going to go into my other comprehensive income and be accumulated as accumulated other comprehensive income over time. The amortization of prior service costs. So when management decides to change the pension plan, they say, for example, our employees have worked hard and they're not getting enough money in their retirement. Inflation has kicked up. We need to increase our defined benefits to match it. So they were getting $5,000 a month, not good enough. Let's make it $6,500 a month now. Well, when they do that, they're not going to leave the people that have been working for them for 30 years hanging. They're going to have to retroactively go back and make it so that their obligation is enough to cover those people who have been working for 30 years and give them the same defined benefit as the people who just started. So this is going to be a pretty enormous cost. Typically, there's only increases in benefits. There would be a huge upheaval if you decreased defined benefits. It's happened, not saying it hasn't, but it is not something that you can just do without thought. So when this extremely large increase occurs, you're going to have to put it into accumulated other comprehensive income and then slowly introduce it into income over time. The reason you do it that way, again, is to avoid volatility of net income, slowly introduce it so that there's a trend over time. Finally, corridor amortization represents my inclusion of accumulated other comprehensive income balances in order to deflate them. If they grow too big, I have to start including them into that balance. So let's go ahead and look at an example. I have a hula hoop service that gives me motivational tools and for universities. And we began 2017 with a PBO of 2.4 million, plan assets also 2.4 million. There was no unrecognized prior service costs, no unrecognized gains or losses. That refers to the AOCI items, accumulated other comprehensive income items. And there were no balance sheet accruals related to pension assets or liabilities, which means that my pension AL is currently 0. The company uses a discount rate of 10% in determining the PBO, has an expected rate of return on plan assets of 8%. The actuary gives me a service cost of it's indicated that the service cost for 2017 will be $350. The company contributed $450 to its pension plan on the last day of the year. During the year, the pension fund earned $192,000. They paid out benefits of $430,000. So given this, let's determine pension asset liability at year end. We know it started at 0, but where was it at year end? We also want to figure out what pension expense is for 2017. So, like I said, I like to use a T account approach where I think about this stuff in terms of a T account for my PBO and a T account for my plan assets. So for the PBO, again, both of these began with a $2.4 million balance. Which means that is why we began with a $0 balance here. Because remember, the balance here is any excess of one of these items over the other, but neither of them has an excess at this point. They're equal to each other, so we don't have any pension asset or liability. Right? We do want to keep track of these accounts, though, because remember, the different pieces of pension expense, the different components, change them over time. So pension expense is what I want to figure out next. Remember, the first thing in pension expense I need to think about is my service cost. Service cost increases pension expense. And the service cost was $350,000. The next thing I want to think about is my interest cost. Interest cost also increases my pension expense. Remember, the interest cost is determined by taking the beginning amount of the PBO, $2,400,000, and multiplying it by the discount rate, which I gave you as 10%. So we solve for that. Yeah. Sorry about that. So we solved for that. Now we have one other item, expected return on assets. The expected return on assets is, again, the beginning plan assets, 2,400,000 times the expected return, which in this case is $192,000. There is no prior service cost to worry about since we have no other AOCI gains or losses. We do not have any corridor amortization to worry about. So this is a very simplified plan. We would have service cost, interest cost, we would subtract our return. And if you think about, well, what goes into an expense? Certainly costs would increase the expense. So we have $350,000 plus $240,000, and then anything you've earned on the fund would intuitively decrease the amount of expense you have, because now you are earning money that you do not necessarily have to record in your obligation. $398,000 would be pension expense for 2017. Now let's look at what the balance of my pension asset liability account would be. And this means we now start plugging in the components of pension expense into the PBO and the plan assets. The service cost of $350,000 would increase my PBO. The interest cost increases my PBO. Now remember, I said not your expected ROA, but your actual return on assets is what you put in your plan assets account. In this case, they're both equal, 192, 192. So it doesn't matter, but you got to be careful because they won't always be equal. I made them equal because I don't want to deal with AOCI items in the first example I give you. That would imply that there is some sort of an unexpected return between the two. Now, the company contributed $450,000 to the pension fund. That any contribution increases my plan assets, and we paid out benefits of $430,000. Well, I'm paying them out of that fund, so that gets them out of that fund, but then it also discharges part of my obligation to my employees. So then I reconcile those accounts. I have plan assets of $2,612,000 at the end of the year, and my obligation is $2,560,000 at the end of the year. All right, so now do we have an overfunded or underfunded plan? Compare the two. Since I have more assets in my plan, in my pension fund, than I have as my defined benefit obligation, I actually have an overfunded fund, which is very unusual. And I would have a pension asset liability of $52,000. Now, how would I journalize this? The journalization is pretty easy once you have everything else laid out. You know that you have a pension expense to record. What else goes in here? Well, I contributed cash of $450,000. The company paid out that cash, and so they credit that as their cash contribution. Remember, that was the cash contribution to plan assets. So that gets paid out. And then the difference between these two items is that. Which establishes the change in the account to get the desired balance. Remember, this is just giving me my desired balance. That is the amount that would go into the journal entry. So that is the beginning lecture for pensions. I'll let you guys work through a problem at the beginning of class, and then we'll probably just jump into some more of the components, not wait for a video, because you really can't do too much with just this bare little bit. We got to start talking about the unrecognized gains and losses, actuarial changes, unrecognized prior service benefits, to really get the full extent of what can happen with these plans.